All right, let's get right into it. We're going to skip the hot stock tips and the so called magic indicators today. Instead, we're talking about the one thing that will actually keep you in the trading game long enough to win, and that's the math. Yeah, it can be brutal, it's definitely unforgiving, but trust me, it's also the very math that will save your trading account. So let me just kick this off with a question for you. Imagine you have a trading strategy that wins 60% of the time. Sounds pretty good, right? I mean, you should be rolling in it. But what if I told you that very same strategy could completely wipe you out, that it could bankrupt you? It sounds crazy, but it absolutely can, and we're going to break down exactly how that happens. The reality for most traders is, well, it's pretty harsh. The statistics don't lie. Something like 90% of traders end up losing money. And a huge reason why is that they just aren't prepared for the inevitable losing streak. And here's the really scary part: one single bad decision, one oversized loss, can literally erase months of your hard earned gains. Now, I'm not telling you this to scare you, I'm telling you this to arm you for the reality of the game. And that brings us perfectly to our first major concept, what I call the math of ruin. See, the reason most traders fail isn't just because they have a few losing trades. I mean, everybody has losing trades. They fail because they have no idea about the brutal mathematics of how losses compound against them. The secret monster in the closet here is something called asymmetric compounding. Now, that sounds a little technical, I know, but the idea behind it is simple and it's absolutely devastating. All it means is that a percentage loss hurts you way, way more than an equal percentage gain helps you. Let me just show you what I mean. Just look at how these numbers get out of control. Okay, so a 10% loss, you need about an 11% gain to get back to even. Manageable, right? A 20% loss needs a 25% gain. Yeah, it hurts, but you can recover. But this is where it gets terrifying. Look at the 50% loss. You are now officially in the danger zone. To recover, you don't need a 50% gain, you need a 100% gain. You have to literally double your remaining money just to get back to where you started. Let that sink in for a second. You have to work twice as hard. You have to find a 100% winner just to stand still. This right here, this is the mathematical trap that ends trading careers, and most people fall right into it without ever seeing it coming. So the real question is, how on earth do you avoid it? Well, the solution is what I call the trader's survival rule. And this isn't just, some good advice. This is a non-negotiable law if you want to last in this business. And that law is incredibly simple. You have to strictly limit your risk on any single trade to just 1 or 2% of your total account. That's it. And here is exactly why that rule is so powerful. Let's just imagine a 7 trade losing streak, which, by the way, will happen to everyone. If you're over there risking a dangerous 10% per trade, guess what? Your account is down over 50%. You're in critical condition. But if you're sticking to a professional 1 or 2%, you're only down about 13%. Does it sting? Sure, but your account is stable. You are still in the game. And this rule does way more than just protect your money. It actually protects your mind. When you risk too much, every single loss feels like an emotional crisis. You get angry, you start revenge trading, you throw all your rules out the window. The 1 to 2% rule is your psychological shield. It transforms what could be an emotional disaster into just another boring cost of doing business. Okay, so let's make this really personal for a minute. It's time to figure out your account's true breaking point. How many consecutive hits can you actually take before you find yourself stuck in that mathematical danger zone we just talked about? I mean, just look at these numbers. It's insane. At 1% risk, you can survive an incredible 68 losses in a row before your account is down by half. But at 10% risk, it only takes 7, just 7 bad trades. And let's not even talk about 20%. That's literally account suicide in just 3 trades. A losing streak of 7 or 10 trades isn't rare, it's a statistical certainty. So, which one of these columns do you want to be living in when it finally hits? Let's put some real numbers to this. Say you've got a 2 lakh rupee account and you hit a nasty 10 trade losing streak. If you were risking a kind of risky 5% on each trade, your account has just plummeted to under 1 lakh 20,000. You've basically lost almost half your money. But if you stuck to that professional 1% risk, your balance is still over 1 lakh 80,000. You're healthy, you're stable, and most importantly, you're still trading. Okay, so we've spent a lot of time on the why. Now we get to the most important part, the how. We're going to turn all this theory into a dead simple formula that you can use before every single trade. This is it. This is the golden goose, the position sizing formula. What it does is tell you exactly how many shares or units to buy to make absolutely sure that if the trade goes against you and hits your stop loss, you only lose your planned 1 or 2%. Not a single rupee more. So let's just walk through a quick example. Let's say your account is 5 lakh rupees and you're sticking to your 1% risk rule. That means a maximum risk on this trade is 5,000 rupees. Okay. You want to buy Reliance at 2,800 and your safety net, your stop loss is at 2,730. So the distance between your entry and your stop is 70 rupees per share. Simple, right? So you just divide your max risk, the 5,000, by your risk per share, the 70, and boom. The formula tells you to buy exactly 71 shares. And if you get stopped out, your loss is precisely what you planned for. No surprises. To make this an unbreakable habit, just run through this little checklist before every trade. What's my balance? What's my risk percentage? Where is my stop loss exactly? How many units does the formula say I can buy? And this is the most critical part, is my stop loss actually in the system, or is it just a wish floating around in my head? Because a mental stop is a fantasy that will eventually cost you everything. So, everything we've talked about today, this isn't just another strategy. Think of it as a new mandate for how you approach the markets from now on. These are the core principles that literally separate the professional traders from the short term gamblers. Let's just quickly recap the mandate. First, remember that losses compound asymmetrically. Losing 50% means you need 100% to get back. That's just math. Your shield against that math is the non negotiable 1-2% rule. You have to accept that losing streaks will happen, and this rule is what keeps you alive through them. And finally, your tool to enforce all of this on every trade is that position sizing formula. So I'm going to leave you with one final question to really think about. Are you trading to get rich on this next trade, or are you trading to stay in the game long enough for your edge to actually play out? Because the professionals, they figured it out a long time ago. Survival isn't just a part of the game, it is the game.